Today, mortgage stress continues to grind higher in March. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Today I'm going to update the data from our surveys for March 2023, and unfortunately mortgage stress is continuing to rise. No surprise really, given the fact that interest rates are still very high. The costs of living, of course, are pretty significant, and many households have been able to refinance to an extent, but others are mortgage prisoners. So today I'm going to walk you through the latest analysis, which of course is up to the end of March from our 52,000 household survey. And just to explain how we do all this, this is the research universe that we run, and essentially we look at getting data from our household surveys and we roll that into our core market model, and the core market model then drives all of the other analysis that we do. And of course we can slice and dice the data all sorts of different ways through our segmentation analysis. And as I have said on several occasions, the segmentation analysis is absolutely critical to understand what is really going on. And of course in our modelling we take the data from our core market model and also overlay various scenarios to create a view as to where things may be going. And those price scenarios are pretty important insofar that, well, there are various future potential options out there. But we look at mortgage stress, the price trajectory history, the buying and selling intentions, migration, economic data, bang it through the core market model, and that gives us the ability to be able to look at different scenarios and where things may be heading. And just in passing, just to say that we still are doing our one-to-one service, though we're in the UK at the moment. We are 5 to 6 weeks perhaps behind where we'd like to be, but we do still offer the opportunity to look at a particular postcode and to look at specific data. It's not financial advice, but it is analysis looking at our data set. We can look at stress, home price, trend data, and look at all the other information to be able to have a little look as to where things may go. And we can book a time for a Zoom or phone discussion up to an hour. There is a cost involved in doing that, and we are 3 to 5 weeks booking ahead at the moment. If you'd like to look at a specific area, drop me a note. You can contact me by the DFA blog. It's in the comments below. Now in terms of stress, just to be clear, we talk about stress based in cash flow terms. There are lots of other different ways of defining stress, but we use cash flow as a model, and we define stress in those terms, money in, money out, which means if households have more outgoings, excluding one-off discretionary items and income, we define them as stressed. If they have a mortgage, they have mortgage stress. If they're renting, they have rental stress. We can also look at investors and their cash flow pressures, and we can look at total financial stress, which is an aggregate measure as well. And we can express each as a percentage of households and also the count. The count probably is a better measure, simply because if you have a very small number of households in a postcode and 100% of them stressed, that may not be significant, whereas you could have a smaller number of households stressed in a big area and a big count, and that would be more significant. So in March 2023, we can see that rental stress came back just slightly, 61.1% of households in rental stress. Now there's two reasons for that. Firstly, some people have got wage rises, particularly low wage rises, and also some people have been switching to cheaper accommodation in less salubrious areas to try and deal with this. Also, mortgage stress is higher at 47.9% of households. That's pretty much as high as it's ever been. And you compare that with February 2020 when it was 32.9%. And by the way, the household debt to income ratio is still extremely high according to the RBA. Not good. Here's the mortgage stress data, and here you can see in yellow those states where in fact mortgage stress has risen. So New South Wales, the NT, Queensland, Tasmania, Victoria and Western Australia all saw a rise. There was a slight fall in South Australia. Rental stress was also up in the ACT and New South Wales and the Tasmania, down a little in some other areas. Investor stress, again, was up in the ACT, South Australia, Tasmania, Victoria, but it was lower in WA, Queensland and New South Wales. And financial stress, which is an aggregate measure, was essentially up a little, but again you can see that there are some significant variations state by state. If we then go on to look at the segmentation analytics, here you can see that, as always, young affluents and young growing families are in the midst of stress. Young growing families, many first-time buyers of course in there, and also battling urban and disadvantaged fringe households still exposed. But we are seeing more other households in other segments now getting into difficulty, and in fact more mainstream segments, including mature stable families, are also now under the gun. From a rental stress perspective, we can see that first generation Australians, those multicultural establishment households, are very much registering at 68.9%, but wealthy seniors are now finding it difficult because of the cost of living pressures. And we're also seeing young affluents difficult, though it may seem to believe, many of those are actually finding it really tough as well. Now, some property investors are also registering some difficulty, and so overall financial stress is rising, and it's highest among young affluents, young growing families, as you'd perhaps expect, but even more affluent households are also impacted. Then we quickly look at the top postcodes. These are sorted by the number in mortgage stress, and you can see there that 3064, which includes Roxburgh Park and Craigieburn in Victoria, is leading the way with more than 12,800 households in mortgage stress. Then Liverpool 2170, and that of course is in New South Wales with 12,339 estimated in mortgage stress. Then we go to Campbelltown 2560, and pretty much every household there is now registering as stressed in cash flow terms. WA is not excluded though, Tapping and places like that in 6065, and then we go to Toowoomba in Queensland, and then back to Victoria with places like Cranbourne, Narre and Berwick and Huckaway. And it's worth explaining, I think, that many of these areas are those high growth corridors where people have been buying off the plan, and a lot of new building has been undertaken. A lot of people have big mortgages and frankly not much wriggle room. It's also worth noting that Ballarat 3350 is on the list, and regional areas are certainly not excluded, so places like Toowoomba and Ballarat and even Queanbeyan in the ACT are now registering. If we look at rental stress, centre of Melbourne, Victorian postcode 3000 is actually the most stressed in terms of count, with more than 13,000. Then we go to Toowoomba, and then we go to Victorian postcode 3029, which includes Hoppers Crossing and Tarnett, and then 2170 Liverpool, and you can see there other high growth corridors like in Cam. And then we've got to Queensland, Southport, places like that, back to New South Wales to Mount Druitt and Blacktown, and then up to Queensland, including Bundaberg, as well as Ipswich. If we go to stressed investors, centre of Melbourne, not surprisingly, is the yin and the yang. So if there are lots of stressed people with rental problems, then investors are going to have issues, so they're right at the top. But then we go up to Queensland, places like Greenvale, Hidden Valley, and then Victorian postcode 3351, which includes places like Haddon, Rokewood Junction, Ross Creek. And then we go to 6014 in Western Australia, which includes Floreat and Jolimont and Wembley. And then Wentworthville in New South Wales, 2145. Then Fortitude Valley up in Queensland. And then the northern beaches in New South Wales like Dee Why and Cromer, places like that, North Curl. And then Randwick, 2031. And even places like Hornsby, 2055. Now some of those are being driven by the fact that people are finding it quite difficult to pay the rents, and the costs of owning those properties for many people, particularly with large mortgages, are really biting now. Finally, we'll look at financial stress. The postcode this month with the most significant financial stress, the aggregate measure, is Toowoomba, postcode 4350, followed then by Liverpool 2170 and Campbelltown 2560, then Roxburgh Park in Victoria at 3064, and then Tarnit and Hobbs Crossing 3029, and then Cranbourne 3977, then the centre of Melbourne, and then Mount Druitt in New South Wales, Durmont and Point Cook in Victoria, places like Tapping in WA 6065, Blacktown in New South Wales 2148, Ipswich 4305, and Belbud Park 4300, and then Queanbeyan in the ACT 2620, Ballarat 3350, and Camden 2570. Now, just quickly on the scenarios, it's worth understanding that our scenarios are just looking at different futures. And of course, some people are claiming that property prices have bottomed and are going to rise from this point. I don't believe it. And so I am running 3 scenarios looking forward from today. The best case for houses is a small fall over the next 12 months. These are cumulative numbers, but a rise after that. The mid case is a more significant fall. The worst case is a very significant fall, which is down more than 40%. The first one is perhaps predicated on the assumption that the RBA cuts quite quickly. But I'm not sure that's going to happen. I think they may have to raise their rates later. And for units, it's a pretty similar story, not quite such significant falls, simply because of the supply-demand dynamics. Just to close this out, I want to highlight that households who have mortgage stress or indeed rental stress quite often seem to me to ignore it. Now, some are able to refinance if they've got a mortgage, and people are still able to save quite a lot if they can refinance, but we are seeing more people now locked into what I call mortgage prisoners, simply because they're not finding anybody who can give them a better rate because they have higher risks and limited equity in their property. Equity, of course, is drained away when property prices fall. From a rental stress perspective, it's a cash flow problem, and that, of course, is to do with the cost of living more generally, and whether you are owner-occupier or whether you are a renter, you are certainly seeing the cost of living, everything from electricity right the way through to other categories, all continue to rise, and there's no end in sight in the short term. Now, if you are one of those households who are struggling with cash flow, the first thing to do is to make sure you understand where you are. So build a cash flow. You can get information off the ASIC website as to how to do that. It's quite a good guideline that they provide. Know where you are, know what money you're spending, know what money is coming in. Then you can make some sensible decisions with regard to prioritising your spending and specifically looking at expenditure with high interest rates attached, particularly credit card debt. The next thing to do once you've prioritised is to really hunker down. And we are seeing many households who had savings, burn those savings, and now starting to access credit, particularly credit cards and buy now, pay later. Of course, adding more credit to the mix is a recipe for disaster later. If you are in difficulty and if you have cash flow issues, talk to your bank is a very good word of advice. The banks are there to help. They do have hardship provisions that require them to try and assist. But remember this, sometimes the advice they will give will be more about securing their mortgage repayments than necessarily being the right thing to use. So sometimes it's good to get independent debt counselling advice, and there are agencies, government agencies in fact, that can provide that. But be cautious, don't just Google advice, because you'll get a lot of sharks who will start charging for advice. The government service is actually free. And then the final thing to say is that if you haven't yet refinanced your mortgage and you are considering doing so, do it quickly, because there are some very good deals out there at the moment. The banks are quite keen to try and capture business, particularly if you've got a variable mortgage refinance. If your mortgage is fixed, of course, it's more complicated because you may have break fees. So you have to do the calculations on an individual basis. And sometimes it's worth talking to a mortgage broker. But again, remember, a mortgage broker is fundamentally there to try and get a transaction because, of course, they get commission. So be cautious about that too. But the bottom line is this. Seeing that we're going to see interest rates grinding around this level or maybe a little higher ahead, mortgage stress is going to continue to grow. I don't see real incomes going to catch up anytime soon, so many households are going to continue to struggle. That means you have to take this by the neck, as it were, and start dealing with it now. The worst thing to do is to put your head in the sand and just hope that magically things will work out. in the current environment, with interest rates remaining high, certainly for many months, that's not going to work. And also, by the way, if you're thinking of buying into the market at this stage, don't assume that interest rates can't go higher. Certainly, there is still an argument to say that the Reserve Bank will have to lift rates higher later. And you don't want to start buying a new property and then finding that mortgage stress comes so quickly. So, the bottom line is this. This is an ongoing, long-term structural problem that we have in Australia. And by the way, in the UK too. I've been looking at the data here in the UK. And so it's important that individual households take control of their finances and start making good decisions to be able to actually deal with it. Certainly, you cannot assume that things are going to magically right themselves in the next few months. I'll update the data next month, and I wouldn't be surprised to see mortgage stress once again rising higher. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.